In this video, we will compare the valuation of Paramount, ticker PARA, to Warner Bros. Discovery. So I have made a lot of videos on Warner Bros. Discovery, but this is the first on Paramount. So we will look at some of the numbers, we will look at their debt level, their dividend, and in the end we will compare the valuation using two valuation metrics, EV to EBITDA multiple and price to free cash flow. So the goal of this video is to determine which stock is a better buy at this price level. So let's get started. First of all, the idea of comparing the valuation of Warner Bros. Discovery to Paramount came to me when I saw this comment. So thank you very much for that comment. If you have investment ideas or you want to make a deeper dive on any company, please write in the comments below. Okay, first let's look at Paramount, ticker PARA. It's a media and entertainment company. It produces various movies, for example Top Gun Maverick. It had a lot of success. Its box office is more than 1.3 billion. The Lost City, Star Trek, Halo, and many others. It has content for kids, news, sports channel, direct-to-consumer subscriptions. A lot of investors are buying Paramount because in the previous quarter, in the second quarter of 2022, Warren Buffett bought Paramount. If you look at the price chart, we can see that the minimum price in the second quarter was around $24 per share. So it is very likely that he bought even higher, but this was the minimum price. And right now the price is around $19 per share at the moment of writing this video. The stock is down around 40% from year to date. So the main reasons for that is the overall market sentiment. The second reason is that a lot of revenue comes from advertising, and we can see the reduction in the advertising budgets. Okay, now let's look at the recent 10Q report. If we look at the revenue by segment, we can see that the most revenue comes from TV media, direct-to-consumer, and filmed entertainment. If we look at their direct-to-consumer segment separately, we can see that 360 million comes from advertising, so around 25% growth, and 830 million comes from subscription, around 74% growth rate. The fastest growing segments are direct-to-consumer and filmed entertainment. We also can see that they have 64 million subscribers, around 5 million additions, and they have 43 million subscribers to Paramount Plus. So they have a lot of growth in their direct-to-consumer segment. If we look at their debt level, we can see that they have around 4 billion in cash and around 17 billion in debt. This brings us their net debt of close to 13 billion. If we look at their dividend yield, we can see that they're paying more than 4% dividend. But if we look at their free cash flow, we can see that they have stressed free cash flow. So Paramount is investing heavily in growth. So this growth comes from free cash flow. So analysts are projecting if they stop investing heavily in their growth, they will have 1 or 2 billion in free cash flow. So if you are a dividend investor, it may be a better idea to find another dividend stock because they do not have stable free cash flow. Okay, this brings us to their valuation. What is their valuation compared to Warner Bros. Discovery? So we will use two valuation metrics. The first is EV to EBITDA multiple. We are using next 12 month EV to EBITDA. So I took all the data from Ticker Terminal. I know that management is projecting higher numbers for Warner Bros. Discovery, but just to be on the conservative side and use consistent numbers, we will take all the data from Ticker Terminal. So if we look at their chart of EV to EBITDA multiple for the last year, we can see that for Warner Bros. Discovery it is 7.8, while for Paramount it is 8.1. So they have almost the same valuation. Warner Bros. Discovery looks a little bit cheaper. Warner Bros. Discovery has much more debt, but they are able to repay that debt using their more stable free cash flow. Also, the majority of their debt is fixed, so rising interest rates may be not as problematic as many people think. So according to this metric, they have almost the same valuation. If we look at their next metric, price to free cash flow, so we're using market cap divided by next 12-month free cash flow. So for Warner Bros. Discovery, it's around 6, while for Paramount, it is more than 30. So they're investing heavily in growth, and the result of that investment may be unknown, while Warner Bros. Discovery is generating stable free cash flow. So that is why we can see such a difference in their numbers. So according to this metric, Warner Bros. Discovery looks much cheaper. Okay, so in this video, we looked at Paramount. I like the fact that they had a lot of success with their recent movies, Top Gun Maverick. I like the fact that Warren Buffett bought the shares. at around $24 per share or higher. Right now the price is much lower. I like the fact that they have lower debt level than Warner Brothers Discovery. They are also investing in their growth. That is why they have unstable free cash flow. On the other hand, Warner Brothers Discovery has much more stable free cash flow. So if we use price to free cash flow as a valuation metric, Warner Brothers Discovery looks much cheaper. Also, if you want to know more about Warner Brothers Discovery, their recent 10Q report, here is the video. If you are not subscribed to the channel, you can do this by pressing the button right here. You will not miss a single new video. Thank you very much for watching till the end, and see you in the next video.